All right, let's dive into a story that, on the surface, sounds a little out there. We're going to connect the dots between a former president, a plan to buy Greenland, and what it could all mean for one single tech stock. It seems like a huge stretch, I know, but a fascinating analysis suggests these things are way more connected than you'd think.
So that's the big question, right? How in the world could a massive geopolitical real estate deal, we're talking about buying an entire country, create the perfect storm for one small company? Well, we're going to unpack that theory and see how a giant macro event could slam right into a very specific micro story.
So first things first, let's set the stage. This all starts with a huge geopolitical idea that made a ton of headlines. But according to this analysis, most people completely missed the real market implications hiding just beneath the surface.
Okay, so the whole theory is built on this one premise, a proposal to actually purchase Greenland from Denmark. In the justification, it's framed as a matter of national security, something absolutely critical. To get the deal done, the plan would involve putting some serious financial muscle on Europe.
And that muscle would come in the form of some pretty hefty tariffs on key European allies. We're talking about starting at 10% and then quickly jumping to 25%, with the threat of going even higher. The whole point is to create enough pressure to bring everyone to the negotiating table.
But here's the twist, and this is what makes this analysis so interesting. The argument is that the tariffs, they're just a distraction. They're a negotiating tactic, basically a smokescreen. The real mechanism that could move the market is hidden in what it would actually take to pay for the whole thing.
And that brings us to the crucial point. How would the US government actually pay for Greenland? This is where the story pivots, moving away from geopolitics and diving right into the plumbing of the financial markets.
The price tag could be as high as $1 trillion. Yeah, with a T. Now that's not cash the government just has sitting in a checking account. To raise that kind of money would have to issue a ton of new debt in the form of US Treasury bonds.
And that move would kick off a very clear chain reaction. First, the government floods the market with $1 trillion of new bonds. It's basic supply and demand, right? When supply shoots up, prices have to fall. And here's the key for a bond. When its price falls, its yield, which is just the interest rate it pays you, goes up.
So why does this matter for the stock market? Well, think about it. When the yield on a totally risk-free government bond goes way up, it starts to look like a really, really good deal. I mean, why would you risk your money in the stock market for an uncertain return when you could get a high, guaranteed return from the government? This tends to suck money out of stocks, putting downward pressure on the entire market, especially on smaller, riskier companies.
Okay, so let's zoom all the way in. We've talked about the huge macro picture. Now let's see how all of that external pressure creates a totally unique situation for one specific company, Resolve AI, which you'll find under the ticker RZLV.
So, while the broader market would be dealing with these pretty serious headwinds from rising interest rates, this analysis argues that RZLV has an incredibly powerful and totally opposite force building up from the inside. It's setting up a potential collision.
First off, just look at the short interest. A jaw-dropping 31% of the company's freely traded stock is being shorted. That means a huge number of investors are placing massive bets that the stock price is about to tank. And to give you some context, that number was only 5% just a few months back.
And here is where the disconnect gets absolutely wild. While you have all these short sellers piling on and betting against the company, Resolve itself just came out with revenue guidance of $350 million. That's more than double what Wall Street analysts were expecting. You couldn't ask for a clearer clash between negative bets and positive reality.
So what happens when you have a massive number of bets against a stock, right at the exact moment the company is signaling that it's surprisingly strong? Well, you get all the classic ingredients for what's known as a short squeeze. That's when all the investors who bet against the stock are suddenly forced to buy it back to cut their losses, which can send the price skyrocketing. And it's not just the short interest. There's a monster position building in the options market too. We're talking over 41,000 open contracts for call options right at the $5 price point. If the stock pushes past $5, it could trigger a forced buying frenzy for over 4 million shares. That's just adding rocket fuel to an already explosive situation.
On top of all that, you can see other little signs that momentum is building. If you look at the chart, the stock is bumping its head against a really key price ceiling. We're seeing a big jump in retail investor interest on platforms like StockTwits, and the general feeling, the sentiment, among those investors is overwhelmingly positive.
So the analysis really boils everything down to this one conclusion. When you combine that massive short interest, the huge options position, and a really strong fundamental story from the company, well, you're looking at the potential for a very fast, very powerful move up.
So let's pull back for a second and look at what we've got. It's a really fascinating scenario. You have a potential macroeconomic storm pushing the entire market down, meeting a powerful microeconomic hurricane that's set to launch a single stock up. It really comes down to this battle between two opposing forces. On one side, you've got the market-wide pressure from rising bond yields, which could hammer small companies like RZLV. But on the other side, you have this company-specific setup, the huge short position, the massive options activity, and that blowout revenue guidance. It is a perfect storm of conflicting pressures centered on one stock.
And this leaves us with the ultimate question posed by this whole analysis. In this unique showdown between a negative market environment and a fiercely bullish individual stock setup, which one is going to break first? Is the macro pressure going to crush the stock, or will the internal momentum be strong enough to actually defy the entire market?